If you feel confused right now, you're not alone. If you feel like the market is trying to give you a heart attack, you are not imagining it. Look at the last 48 hours. On Wednesday, New Year's Eve, the price of silver crashed. It fell 8%. It smashed down to $70.50. The sentiment was apocalyptic. People were selling. They were screaming that the bull run was over, and now, today, Friday, January 2nd. The market opens and silver rips higher. We are trading at $73.83. We are up over 3% in a single session. We have erased half of the crash in the blink of an eye. If you sold on Wednesday, you are devastated. You sold the bottom. If you bought the breakout on Monday, you are still underwater. The market is whipping back and forth like a downed power line. It is destroying the bears on Monday. It is destroying the bulls on Wednesday. And today, it is coming back for the bears. Again, this is not a trend. This is a trap. This is a market that is designed to maximize pain. It is designed to shake you out of your position by making you doubt your own sanity. In professional trading, we call this a meat grinder. It chops up anyone foolish enough to use leverage. In this emergency market analysis, we are going to dissect the anatomy of this whiplash. We are going to explain why the banks are engineering this volatility to clear the board before the real move begins. We are going to look at the $70 floor and the $75 ceiling. We are stuck in a war zone between these two numbers, and I am going to give you the strategy to survive the chop. Because if you try to trade this, you will lose. But if you understand why it is happening, you can use it to your advantage. The price is moving fast, but it isn't going anywhere yet. It is hunting for liquidity. This is the story of the trap. To understand the trap, you have to look at the psychology of the swing. Why did we crash on Wednesday? We discussed it. It was the G-SIB regulatory flush. The banks needed cash. Why are we rallying today? Because that selling pressure is gone. The calendar turned to January. The banks stopped selling. The natural buyers stepped back in, but notice the range. We fell from 75. We bounced to 73.80. We are still inside the crime scene. We have not broken out to new highs. We have not broken down to new lows. We are trapped in the middle. This middle zone is the kill zone. It is where the algorithms feast on retail traders. When the price goes up 3% today, the retail trader feels FOMO. They think, oh no, it's recovering. I have to buy. So they buy at 73.80. And then what happens if the price drops tomorrow? They panic and sell. The market is washing the order book. It is flushing out the weak hands on both sides. The banks want a clean slate for 2026. They want to make sure that nobody is holding a leveraged position that threatens them. So they shake the tree. Hard. Up $3, down $6, up $2, until everyone lets go. This volatility is a tax on impatience. If you are looking at the chart every 10 minutes, you are paying the tax. Your emotions are being harvested by a supercomputer in New Jersey. The only way to win is to refuse to play the short-term game. Let's look at gold for a moment. Gold is trading at $4,363. It is up nearly $40 today. Gold is the anchor. While silver is acting crazy, jumping 8% down and 3% up, gold is steady. It held the support. It is slowly grinding higher. This tells us that the macro trend is safe. The inflation trade is alive. The safe haven trade is alive. If gold had crashed $500, I would be worried. But gold is simply consolidating near all-time highs. This means the chaos in silver is specific to silver. It is caused by the thin liquidity of the holiday week. Remember, a lot of traders are still on vacation. When volume is low, it is easy to push the price around. A single buy order can send it up $2. A single sell order can send it down $2. We are in a low fidelity environment. The signal is noisy. Do not mistake the noise for a trend change. Now, let's talk about the short squeeze narrative. On Monday, everyone thought the squeeze was happening. On Wednesday, everyone thought the squeeze failed. Today, people think the squeeze is back on. The truth is, the squeeze hasn't even started. A real short squeeze, like nickel in 2022, doesn't have down days. It goes up and up and up until the exchange closes. What we are seeing now is positioning. The big players are fighting for territory. The bulls are digging trenches at $70. The bears are building walls at $75. We are watching trench warfare. In trench warfare, the line moves back and forth a few inches every day. Thousands of dollars are lost fighting over $73. But eventually, one side runs out of ammo. We need to watch for the breakout. Buying here in the middle of the range is gambling. You are betting on a coin flip. Will it go to 75? Maybe. Will it go back to 70? Maybe. The smart money waits. They wait for the price to pick a direction. Let's look at the January effect again. Today is January 2nd, the first trading day. We are seeing buying. That is good. It confirms that pension funds are dipping their toes in. But are they all in? Probably not. They see the volatility too. A conservative fund manager does not buy $1 billion of silver on a day when it is whipping around like a roller coaster. They buy slowly. They use limit orders. I will buy at $72. I will not pay $74. This passive buying creates support, but it doesn't create a rocket. It creates a floor. So we might see the price grind sideways for a while as these big funds accumulate. They don't want to spike the price. They want to buy cheap. They are the ones absorbing the volatility. They are the ones catching the falling knives. You should draft behind them. We need to discuss the trap of leverage one more time. I cannot stress this enough. If you bought a futures contract on Monday at $80 and the price dropped to $70 on Wednesday, you got a margin call. You were liquidated. You lost your money. Today, the price is back up. If you had held, you would be recovering. But you couldn't hold because leverage killed you. This market is hunting leverage. It is specifically targeting people who are borrowing money to trade. If you are trading with cash, you are immune. $70 is just a number. $73 is just a number. Your ounces are safe. But if you're on margin, these swings are lethal. The banks know this. They're shaking the box to hear if anything rattles. If you rattle, you are the target. So as we watch the close today, do not celebrate too hard. We are up. That is good, but we are not out of the woods. We are still inside the ghost week window. Monday is when the real volume returns. Monday is when the adults come back to the desk. Until then, we are in the playground of the algorithms, and the algorithms are playing a game of capture the flag with your capital. In the next section, we are going to look at the technical levels. We are going to map out exactly where the trapdoors are. We are going to look at the $70 support and why it must hold at all costs. And we are going to look at the $75 resistance. The battle is defined by these two lines. Everything in between is noise. Stay focused. The volatility is the test. Let's see if we can pass it. We need to define the battlefield. In war, you have a no man's land. The area between two trenches where nobody survives. In the silver market right now, that no man's land is the zone between $70 and $75. If you are trading inside this zone, you are taking fire from both sides. The bears are shelling from $75. They are selling every rally. The bulls are shelling from $70. They are buying every dip. And you, the retail investor, are stuck in the middle trying to dodge the explosions. In part 2, we are going to map out the kill box. I'm going to show you the technical lines that the algorithms are defending. We are going to explain the concept of a liquidity sweep, why the price had to drop to $70.50 on Wednesday to find enough fuel to rise today. And we are going to look at the physical disconnect again. While the paper price is whipping back and forth, the physical dealers are doing something very different. They are holding the line. The chart is a mess, but the message is clear. We are coiling. Let's look at the levels. Why did the price bounce at $70.50? Why not $68? Why not $65? Because $70 is the new structural floor of the global silver market. Think back to November. $70 was the ceiling. It was the resistance that held us down for weeks. When we broke through it, that ceiling became the floor. This is the polarity principle. The market must test the floor to see if it holds the weight. Wednesday was the stress test. The banks jumped up and down on the floor. They tried to smash through it, but the floor didn't crack. This tells us that there is a massive concentration of limit buy orders sitting at $70. These are not retail orders. Retail panic sells at $70. These are institutional orders, pension funds, industrial hedgers, sovereign wealth funds. They have drawn a line in the sand. We will buy anything at $70. This gives you, the investor, a massive advantage. You know where the safety net is? If you buy at $73, your risk is $3. You know the floor is at 70. If we break 70, then the thesis is wrong. But as long as 70 holds, the path of least resistance is up. The market has proven that there are more buyers at $70 than there are sellers. That is the definition of a bull market. Now, let's talk about why the crash happened. It wasn't just G-SIB regulations. It was a liquidity sweep. Markets move based on liquidity. If a whale wants to buy $100 million of silver, he cannot just buy it at the current price. There aren't enough sellers. If he hits buy, the price spikes and he gets a bad entry. So he needs to find sellers. Where are the sellers hiding? They are hiding behind their stop-loss orders. Thousands of traders had stop-losses sitting at $72. The whale knows this. The algorithm knows this. So the market hunts those stops. It pushes the price down to 72, then 71, then $70.50. Snap. The stops trigger. The retail traders are forced to sell. Liquidity floods the market. And who's there to catch it? The whale. The crash was a mechanism to generate the liquidity needed for the next rally. The whale used your fear to fill his order. And once his order was filled, the selling pressure vanished. The price snapped back to $73 because the artificial selling was done. This is a dirty game. It is ruthless. But it is how markets work. The sweep is over. The liquidity has been harvested. Now the market is light. It is ready to move. While the paper price was playing these games, what did the physical price do? Did the price of a silver eagle drop to $70? No. I tracked the premiums all day yesterday. When spot hit $70.50, the dealers raised their premiums. Why? Because they didn't believe the drop. They knew it was a paper flush, but they were not willing to sell their inventory at a discount just because some algorithm in New York was having a tantrum. So the street price stayed at $90. This is a massive signal. It means the real world has divorced the paper world. The paper world is volatile. It swings 10% a day. The real world is stable. It is priced for scarcity. If you are a physical holder, do not look at the spot chart. It is lying to you. Look at the dealer site. That is the real value of your stack. And that value did not crash. It held firm. The dealers are the ultimate insiders. They see the flow of metal. And they are telling you, we are not lowering the price. Now, let's look at the mining stocks. They're having a hard time. Imagine trying to value a mining company when the price of their product swings $8 in 24 hours. It is impossible. Analysts cannot build a model. Do we value Hecla at $70 silver or $80? This uncertainty creates volatility in the equity markets. Investors hate uncertainty, so they sell the miners. This is why the mining stocks are lagging the metal today. Silver is up 3%. The miners are up 1%, maybe 2%. They are confused. But this confusion is an opportunity. The base case for these miners has shifted. Last year, the base case was $25 silver. Today, the bear case is $70 silver. Think about that. The worst case scenario, the crash scenario, is $70. At $70, these companies are printing cash. Their margins are 60%. So the stock market is mispricing the risk. They are pricing in a collapse that isn't happening. Once the price stabilizes, once the volatility dies down, the value investors will return to the miners. They will do the math. Wait, this company has a PE of 4, and they will buy. The miners are a coiled spring inside a coiled spring. If you have patience, this is the deepest value sector on the board. Let's get technical for a moment. Look at the daily candle for today, Friday. Yesterday was a massive red bar down. Today is a green bar, but it is inside the range of yesterday's bar. The high of today is lower than the high of yesterday. The low of today is higher than the low of yesterday. In trading, this is called an inside bar. It represents compression. The market is taking a breath. It is deciding. It is like a spring being squeezed from both ends. Usually, an inside bar is followed by an explosive move in the direction of the break. If we break the high of the inside bar on Monday, it signals that the buyers have won. The trend resumes. If we break the low, it signals another test of $70. So, Monday is critical. Monday will tell us which way the spring releases. Given the January effect setup, the odds favor an upward break. But we must respect the chart. We are in a box. $70 to $75. We are bouncing off the walls of the box. Do not try to predict the break. Wait for it to happen. So the floor is 70. The ceiling is 75. The dealers are holding 90. We are heading into the first weekend of the year. The markets will be closed, but the anxiety will be high. In part 3, we are going to look at the weekend outlook. We are going to discuss the geopolitical risks that could gap the market up on Sunday night. We are going to look at the gold signal again. Why gold holding $4,360 is the key to silver's survival. And we are going to talk about the volume profile for next week. When the real money returns on Monday, how much volume will they bring? $50 billion? $100 billion? The trap has been set. The liquidity has been swept. Now we wait for the explosion. Stay tuned for part 3. We are looking at the week ahead. We need to talk about the weekend. It is Friday afternoon. The closing bell is approaching. The market is about to shut down for 48 hours. Usually weekends are a time to relax. But in a market this volatile, in a market that moves 8% down and 3% up, the weekend is a risk factor. It is called gap risk. While the COMEX is closed, the world keeps turning. Geopolitics happens, war happens, currency failures happen. If a major headline breaks on Saturday, when the market opens on Sunday night, the price will not be $73. It could be $78. It could be $68. It will gap to the new reality. In part 3, we are going to look at the weekend outlook. We are going to analyze the gold signal, and we are going to look at the volume profile for next week. Because next week, the first full week of January, is when the real money returns from vacation. The $50 billion we talked about? It hasn't even arrived yet. The trap has been set. The spring is loaded. Let's see where it points. I want you to look at gold. Gold is trading at $4,363. It is up nearly 1% today. Why is this important for silver? Because gold is the general, silver is the soldier. Where the general goes, the soldier follows. On Wednesday, when silver crashed, gold dipped. But gold did not break its structure. It held the line. It refused to close below the key support levels. This tells us that the macro thesis is intact. The big money, the central banks, the sovereigns, they are not selling gold. They are buying the dip. If the smart money is buying gold, then the silver crash was a fake out. It was a derivative event, not a monetary event. Silver is just more volatile. It overreacts. When gold sneezes, silver gets the flu. But when gold gets healthy, silver runs a marathon. Right now, gold is healthy. It is consolidating near all-time highs. This acts as a magnet for silver. The gold to silver ratio is currently around 59. Historically, in a bull market, that ratio wants to go to 30. For that to happen, silver has to run twice as fast as gold. So, if gold is stable, silver has a green light to explode. Watch gold this weekend. As long as it holds $4,300, the silver bull is safe. Now, let's talk about next week, Monday, January 5th. This is the first real trading day of the year. Why? Because this week was a holiday week. Many senior traders were still skiing. Many offices were half empty. The volume we saw today was just the vanguard. On Monday, the main army arrives. The senior portfolio managers return to their desks. The investment committees meet to finalize their Q1 allocations. The algorithmic buying programs are turned on full blast. This means the volume is going to spike. When volume increases in a tight market, volatility increases. The liquidity vacuum we saw this week will be filled with institutional orders. These orders are huge. They are not looking to scalp a few cents. They are looking to build positions for the next 10 years. This institutional volume is sticky. When a pension fund buys, they don't sell the next day. They hold. This removes the float from the market permanently. So, next week, we are going to see the true strength of the market. If we see high volume and rising prices, it confirms the January effect. It confirms that the crash was just a chance for the big boys to get in cheap. We also have to consider the world stage. While we stare at charts, tensions are rising in the Middle East and the South China Sea. The shipping routes in the Red Sea are still under threat. Supply chains are fragile. Silver is a strategic metal. It is used in missiles. It is used in satellites. If a conflict escalates over the weekend, the military demand for silver becomes priority one. We discussed the Defense Production Act in our deep dive. That threat is always lurking in the background. Smart money holds silver as a geopolitical hedge. They know that if war breaks out, paper assets crash. But hard assets fly. Going into the weekend cash heavy is risky. You're betting on peace. Going into the weekend silver heavy is prudent. You're betting on chaos. And looking at the news, chaos is the safer bet. I have to warn you about the close today. It is Friday afternoon. The banks might try one last trick. They might try to paint the tape lower into the close. They want the weekly chart to look weak. They want to print a doji or a shooting star on the weekly candle to discourage the technical traders. So if you see a sudden drop in the last 15 minutes of trading, do not panic. It is manipulation. It is window dressing in reverse. They are trying to make the chart look bad so they can buy cheaper on Monday. Smart traders ignore the last 15 minutes of a holiday week. They look at the body of the candle, not the wick. And the body of the candle says, we are trading well above $70. That is strength. Let's check the physical market one more time. While the paper price whipsaws, the physical metal is disappearing. We are hearing reports that the Shanghai Gold Exchange is seeing record withdrawals. China is taking the metal. They are not day trading. They are taking possession. This physical drain creates a time limit on the manipulation. The banks can only smash the paper price as long as they have some physical metal to back it up. Once the vaults are empty, the paper game ends. We are getting closer to that day. Every time the price dips, China buys more. Every time the price dips, the vault drains faster. The trap the banks set for you is actually a trap for themselves. They are selling their lifeboats to buy deck chairs on the Titanic. So we have gold holding. We have the main army arriving on Monday. We have China draining the vault. The setup is perfect. But the hardest part is the psychology. How do you hold when your account swings 10% in a day? How do you sleep when the media tells you it is a bubble? How do you resist the urge to sell too early? In part 4, the final chapter of this series, I'm going to give you the psychological armor. I am going to teach you how to think like a whale. I am going to give you the exit targets for 2026, so you don't have to guess. And I am going to leave you with the final verdict on why this trap was the best thing that could have happened to us. The chop is almost over. The trend is about to resume. Stay tuned for part 4. We are finding the calm in the chaos. We have reached the final chapter of this market alert. We have navigated the crash of New Year's Eve. We have analyzed the bounce of January 2nd. We have exposed the trap, the liquidity sweep, and the physical disconnect. Now, you are left with a portfolio that has survived the most volatile week of the year. But survival is not enough. You want to thrive. To thrive in a market that whipsaws 8% in a day, you need more than a chart. You need psychological armor. In this final breakdown, part 4, I'm going to give you the whale mindset. I'm going to teach you how the biggest investors in the world look at volatility, not as a threat, but as a tool. I'm going to map out the exit targets for 2026, so you have a clear plan when the mania hits. And I am going to leave you with the final verdict on why this week's trap was actually the launch pad for the rest of the year. The banks tried to shake you out. They failed. Now, let's make sure they pay. Let's finish this. How does a billionaire trade silver? Does he stare at the 1-minute chart? No. Does he panic when the price drops $2? No. He uses time arbitrage. The retail trader is playing a game of minutes or hours. The whale is playing a game of years. The whale knows that the fundamental deficit in silver cannot be fixed in a day. It takes 10 years to build a mine. So the whale buys the asset today, knowing that in 3 years, the shortage will be acute. He is arbitraging time. He is buying from impatient people today to sell to desperate people tomorrow. This week, we saw the impatient people sell. They sold at $70 because they were scared of the daily chart. The whales bought at $70 because they were looking at the decade chart. You need to adopt this mindset. Stop asking, what will silver do tomorrow? Start asking, where will silver be when Samsung runs out of paste? Where will silver be when the US debt hits $40 trillion? When you lengthen your time horizon, the volatility disappears. The crash becomes a blip. The rally becomes a trend. Be the whale. Play the long game. Now let's talk about the exit. You don't buy silver to hold it forever. You buy it to preserve wealth until the system breaks, and then you swap it for real assets. So what are the targets for 2026? Target 1, $85. This is the technical breakout level. Once we clear the all-time high friction at 50 and 80, the chart opens up. $85 is the confirmation that the new paradigm is here. At this level, you do nothing. You hold. You let the momentum build. Target 2, $100. This is the media event. When we hit triple digits, the world will go crazy. This is when your friends call you. This is when the frenzy starts. At $100, you might consider taking your initial investment off the table if you need the cash. But the smart play is to wait for the ratio. The ratio target, 30 to 1. We discussed this before, but it bears repeating. Do not sell for dollars, sell for gold. When the gold to silver ratio hits 30, swap some silver for gold. When it hits 15, swap it all. This strategy protects you from selling early. It forces you to stay in the trade until silver is historically overvalued relative to gold. Right now at 60 to 1, silver is still historically cheap. We have a long way to go. The biggest risk you face in 2026 is not a crash. It is selling too soon. It is premature evacuation. You have suffered through the bear market. You have held through the consolidation. Now, the payoff is starting. If you sell at $75, you are eating the appetizer and skipping the main course. The big money is made in the third phase of a bull market. The mania phase. We are just entering the mania phase. The public is just waking up. The institutions are just waking up. If you sell now, you are giving your seat to a pension fund. Do not do it. You have earned the right to ride this to the top. Strap yourself to the mast, like Odysseus, put the sell button away, let the market go parabolic. So, here is the verdict on the Whiplash week. It was a trap. It was designed to steal your shares. It failed. The market recovered. The price is back above $73. The weekly candle looks strong. The monthly candle looks historic. The yearly candle signals a supercycle. The banks threw their best punch, and the market is still standing. This tells us that the underlying demand is stronger than the manipulation. The physical hand is stronger than the paper hand. As we head into the weekend, relax. You are positioned correctly. You own the asset that is running out. You own the money of the future. Monday will bring volume. Monday will bring the main army, and Monday will likely bring higher prices. The trap is empty. The road is clear. Welcome to the year of silver. Subscribe.